Section 2.1 to 2.3 Capital Gains, 2.1 Basis and Cost of Acquisition. The cost basis of an investment refers to the original purchase price of the investment asset. It is used to calculate capital gains or losses when the investment is sold or otherwise disposed of. The cost basis is crucial for determining the taxable gain or loss on an investment and is important for tax reporting purposes. Here are a few methods commonly used to determine the cost basis. Purchase price. The most straightforward method is to use the actual purchase price of the investment. This is the amount paid to acquire the investment, including any commissions or fees associated with the purchase. Average cost, for investments where multiple purchases have been made over time. The average cost method can be used. It involves taking the average of all the purchase prices to determine the cost basis. This method is commonly used for mutual funds or other investments with periodic contributions. Specific identification. In some cases, investors may have the option to specify which shares or units of an investment they are selling. This method allows them to choose the specific purchase price associated with the shares being sold, which can be advantageous for tax planning purposes. Adjusted cost basis. The cost basis can be adjusted to account for certain events or factors that impact the investment's value. For example, if an investor incurs expenses related to the investment, such as fees, commissions, or improvements, these costs can be added to the original purchase price to adjust the cost basis. It's important to maintain accurate records of investment transactions, including purchase dates, purchase prices, and any adjustments or expenses associated with the investment. This documentation is essential for determining the cost basis and accurately reporting capital gains or losses for tax purposes. It is recommended to consult with a tax professional or financial advisor for specific guidance on determining the cost basis of investments, as tax laws and regulations may vary and can be complex. When determining the cost basis of an investment, it's important to factor in transaction costs such as commissions and fees associated with buying or selling the investment. These costs can affect the overall cost basis and, consequently, the calculation of capital gains or losses. Here's how transaction costs are typically accounted for. Add to purchase price. When calculating the cost basis for an investment, you should include any commissions, brokerage fees, or transaction costs paid at the time of purchase. These costs increase the overall purchase price of the investment and, therefore, affect the cost basis. For example, if you purchased a stock for $1,000 and paid a $10 commission, the cost basis would be $1,010, subtract from sale proceeds. Similarly, when selling an investment, transaction costs incurred during the sale should be subtracted from the proceeds of the sale. This reduces the amount realized from the investment and affects the calculation of capital gains or losses. For example, if you sold a stock for $2,000 and paid a $20 commission, the proceeds for tax purposes would be $1,980. Adjusted cost basis. Transaction costs can also be factored into the cost basis through an adjusted cost basis calculation. This method involves adding the transaction costs to the original purchase price and subtracting the transaction costs from the sale proceeds. This adjusted cost basis is then used to calculate capital gains or losses. Using the previous examples, if you purchased a stock for $1,000 with a $10 commission and sold it for $2,000 with a $20 commission, the adjusted cost basis would be $1,020, $1,000 $10 to $20, and the capital gain would be $980, $2,000 to $1,020. It's important to keep detailed records of transaction costs, including receipts or brokerage statements, to accurately account for them when determining the cost basis and calculating capital gains or losses. Properly factoring in transaction costs ensures accurate tax reporting and can have a significant impact on the amount of tax owed on investment gains. If you are unsure about how to account for transaction costs, it's recommended to consult with a tax professional or financial advisor for guidance specific to your situation and jurisdiction, when it comes to adjusting the cost basis for stock splits, dividends, and other corporate actions. It's important to consider the impact these events have on the overall investment value and the number of shares owned. Here's how you can adjust the cost basis for these corporate actions. Stock splits. A stock split occurs when a company divides its existing shares into multiple shares. For example, A 2-for-1 stock split would double the number of shares outstanding, with each shareholder receiving an additional share for every share they already own. In a stock split, the cost basis per share is adjusted to reflect the increased number of shares. To calculate the adjusted cost basis per share, divide the original cost basis by the new number of shares. The total cost basis remains the same. For example, if you initially purchased 100 shares for $1,000 and there is a 2-for-1 stock split, you would now own 200 shares with an adjusted cost basis of $5 per share, $1,000/200. Stock dividends. A stock dividend is when a company distributes additional shares to its shareholders as a dividend instead of cash. Similar to a stock split, the cost basis per share is adjusted to account for the additional shares received. To calculate the adjusted cost basis per share, divide the original cost basis by the total number of shares owned after the dividend distribution. The total cost basis remains the same. For example, if you initially purchased 100 shares for $1,000 and received a stock dividend of 10%, resulting in 10 additional shares, you would now own 110 shares with an adjusted cost basis of $9.09 per share, $1,000/110. Stock spin-offs or mergers. In the case of a stock spin-off or merger, where a company divides into separate entities or merges with another company, the cost basis of the original investment needs to be allocated between the new entities. This allocation is typically based on the fair market value of the original investment and the fair market value of the new entities. Consult the specific documentation or tax information provided by the company to determine the appropriate cost basis allocation in such cases. Other corporate actions, different corporate actions, such as stock consolidations, rights offerings, or reorganizations, may also require adjustments to the cost basis. The specifics of these adjustments depend on the nature of the corporate action and the guidance provided by the company. It's essential to consult the company's documentation or seek guidance from a financial advisor or tax professional to accurately adjust the cost basis. Properly adjusting the cost basis for stock splits, dividends, and other corporate actions ensures accurate tax reporting and the calculation of capital gains or losses when selling the investment in the future. Keeping detailed records of corporate actions and consulting with professionals when necessary can help ensure the cost basis adjustments are handled correctly. 2.2 Capital Gain Calculation. The calculation of capital gains is based on the cost basis of an investment and the sale proceeds. Capital gains represent the difference between the amount received from selling an investment, sale proceeds, and the original purchase price, cost basis. Here's how you calculate capital gains. Determine the cost basis. The cost basis is the original purchase price of the investment, including any transaction costs such as commissions and fees. It also includes adjustments for certain events like stock splits or dividends. If you acquired the investment through means other than a purchase, example, inheritance or gift, the cost basis may be different and will depend on the specific circumstances and applicable tax regulations. Calculate the sale proceeds. The sale proceeds represent the amount received from selling the investment. It includes the actual sale price minus any transaction costs incurred during the sale, such as commissions or fees. Subtract the cost basis from the sale proceeds. To calculate the capital gains, subtract the cost basis from the sale proceeds. If the sale proceeds are higher than the cost basis, you have a capital gain. If the sale proceeds are lower, you have a capital loss. Capital gains equals sale proceeds, cost basis, short-term versus long-term capital gains. Depending on the holding period of the investment, capital gains are categorized as either short-term or long-term. In most jurisdictions, if you hold the investment for 1 year or less before selling it, the capital gain is considered short-term. If you hold it for more than 1 year, the capital gain is considered long-term. Tax rates on short-term capital gains are typically higher than those on long-term capital gains. Tax considerations. It's important to note that capital gains are generally subject to taxation. The tax treatment of capital gains can vary depending on your jurisdiction and the specific circumstances. Tax laws may have different tax rates or tax exemptions for certain types of investments or holding periods. It's advisable to consult with a tax professional or refer to the tax regulations in your specific jurisdiction for accurate and up-to-date information on the tax treatment of capital gains. It's crucial to maintain accurate records of investment transactions, including purchase and sale dates, purchase price, sale price, and any transaction costs, to facilitate the calculation of capital gains. These records will help ensure accurate tax reporting and compliance with tax laws. When accounting for adjustments like reinvested dividends and return of capital, it is important to consider their impact on the cost basis of an investment. These adjustments can affect the original purchase price and, consequently, the calculation of capital gains or losses. Here's how you can account for these adjustments. Reinvested dividends. When dividends are reinvested, they are used to purchase additional shares of the investment instead of being received as cash. The reinvested dividends increase the number of shares owned and, therefore, affect the cost basis per share. To account for reinvested dividends, you need to adjust the cost basis by adding the value of the reinvested dividends to the original purchase price. This increases the overall cost basis of the investment. For example, if you received $100 in dividends and reinvested them to purchase additional shares, you would add $100 to the cost basis. Return of capital. In some cases, an investment may return capital to the investor. This could happen when a company returns a portion of the original investment to shareholders. The return of capital reduces the cost basis of the investment. To account for the return of capital, you subtract the amount received from the original purchase price. This reduces the overall cost basis of the investment. For example, if you received $50 as a return of capital, you would subtract $50 from the cost basis. It's important to keep accurate records of reinvested dividends, return of capital, and any other adjustments to the cost basis. These records are crucial for calculating accurate capital gains or losses when you sell or dispose of the investment. Additionally, it's recommended to consult with a tax professional or financial advisor for guidance specific to your situation and jurisdiction, as the treatment of adjustments may vary based on tax laws and regulations. By properly accounting for adjustments like reinvested dividends and return of capital, you can ensure accurate tax reporting and calculations of capital gains or losses, ultimately facilitating compliance with tax regulations. Calculating capital gains for different investment assets and scenarios follows a similar principle of subtracting the cost basis from the sale proceeds. Here's a breakdown of how capital gains can be calculated for various investment assets and scenarios. Stocks. To calculate capital gains from selling stocks, subtract the cost basis, including any adjustments, from the sale proceeds. The cost basis is the original purchase price of the stock plus any transaction costs. For example, if you bought 100 shares of a stock at $50 per share, $5,000 total, and sold them for $70 per share, $7,000 total, your capital gain would be $2,000, $7,000 to $5,000. Bonds. Capital gains from selling bonds are calculated similarly. Determine the cost basis, which includes the purchase price, accrued interest, and any transaction costs. Subtract the cost basis from the sale proceeds to calculate the capital gain. For example, if you bought a bond for $10,000, received $500 in accrued interest, and sold it for $11,000, your capital gain would be $1,500, $11,000 to $10,000, $500. Real estate. Calculating capital gains on real estate can be more complex due to factors such as improvements, depreciation, and potential recapture of depreciation. The cost basis includes the purchase price, closing costs, and certain improvements made to the property. Subtract the cost basis from the sale proceeds to calculate the capital gain. It's advisable to consult with a tax professional or real estate expert to accurately calculate capital gains on real estate. Mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, may have more intricate capital gain calculations due to the potential distribution of dividends, capital gains, or return of capital by the fund. The fund company typically provides information on the distribution amounts and their tax implications. You may need to adjust the cost basis to account for these distributions before calculating the capital gains from selling the fund. Inherited or gifted assets. when calculating capital gains for inherited or gifted assets, the cost basis may differ from the original purchase price. In these cases, the cost basis is often determined by the fair market value at the time of inheritance or gifting. Consult tax professionals or legal advisors to accurately determine the cost basis and calculate capital gains for these scenarios. Remember that different jurisdictions may have specific rules and tax regulations that can impact the calculation of capital gains. It's important to consult with tax professionals or financial advisors who can provide guidance tailored to your specific circumstances and the applicable tax laws in your jurisdiction. 2.3 Taxation of capital gains. The tax implications of capital gains depend on several factors, including the type of asset, the holding period, and the tax laws of the jurisdiction in which you reside. Here are some key points to consider regarding the tax implications of capital gains. Tax rates. Capital gains are generally subject to tax, but the tax rates can vary based on the holding period and the tax laws in your jurisdiction. In many countries, including the United States, there are different tax rates for short-term capital gains, held for 1 year or less, and long-term capital gains, held for more than 1 year. Long-term capital gains often benefit from lower tax rates compared to ordinary income tax rates. Holding period. The length of time you hold an investment can affect the tax treatment of capital gains. Long-term capital gains typically receive more favorable tax treatment than short-term capital gains. Short-term capital gains are often taxed at the taxpayer's ordinary income tax rate, which can be higher. Tax exemptions and deductions. Some jurisdictions provide tax exemptions or deductions for certain types of investments or capital gains. For example, in the United States, there are provisions like the primary residence exemption, where a portion of the capital gains from the sale of a primary residence may be excluded from taxation up to certain limits. Tax losses and carryforward. Capital losses can be used to offset capital gains in the same tax year, potentially reducing the overall tax liability. If the losses exceed the gains, there may be an opportunity to carry forward the excess losses to future tax years to offset future gains. Tax reporting and compliance. It is important to accurately report capital gains on your tax return and comply with the tax regulations in your jurisdiction. You may need to provide documentation and details of the transactions, including purchase and sale dates, purchase price, sale price, and any transaction costs. Investment accounts. Different types of investment accounts, such as individual retirement accounts, IRAs, or tax-advantaged accounts like 401(k)(s) or ISAs, may have specific tax implications for capital gains. Contributions, withdrawals, and the timing of selling investments within these accounts can impact the tax treatment of capital gains. Tax laws and regulations can be complex and vary across jurisdictions. It is strongly recommended to consult with a qualified tax professional or financial advisor who can provide guidance specific to your situation and help you navigate the tax implications of capital gains in your jurisdiction. The difference in tax rates for short-term and long-term capital gains is a key consideration in understanding the tax implications of capital gains. In many jurisdictions, including the United States, the tax rates for short-term and long-term capital gains are distinct. Here's an overview of the difference. Short-term capital gains. Short-term capital gains are generated from the sale of an investment that was held for 1 year or less. These gains are typically taxed at the taxpayer's ordinary income tax rate. In most jurisdictions, ordinary income tax rates are higher than long-term capital gains tax rates. The specific tax rate for short-term capital gains depends on the individual's income tax bracket. Long-term capital gains. Long-term capital gains arise from the sale of an investment held for more than 1 year. These gains usually receive more favorable tax treatment, with lower tax rates compared to short-term capital gains. The rationale behind this differential tax treatment is to encourage long-term investment and provide an incentive for individuals to invest for the long haul. Long-term capital gains tax rates are typically lower than ordinary income tax rates. The exact tax rates for long-term capital gains vary by jurisdiction. In the United States, for example, the tax rates for long-term capital gains are divided into different brackets based on an individual's taxable income. As of the knowledge cutoff date in September 2021, the tax rates for long-term capital gains in the U.S. are generally 0%, 15%, or 20% depending on the taxpayer's income level. However, it's important to note that tax laws can change, and it is essential to refer to the current tax regulations in your jurisdiction for the most up-to-date information on tax rates. It's worth mentioning that certain exceptions or phase-outs may apply to long-term capital gains tax rates for high-income individuals. And additional surtaxes or state taxes may also be applicable in some cases. Understanding the distinction in tax rates for short-term and long-term capital gains is crucial for tax planning and investment decisions. It is advisable to consult with a qualified tax professional or financial advisor who can provide personalized guidance based on your specific circumstances and the tax laws in your jurisdiction. Tax planning strategies can help minimize the tax impact of capital gains. Here are some common strategies that individuals use to manage their capital gains tax liability. Long-term holding. Holding investments for more than 1 year can qualify them for long-term capital gains tax rates, which are often lower than short-term rates. By adopting a long-term investment approach, you can potentially reduce your tax liability. Tax loss harvesting. Tax loss harvesting involves selling investments that have experienced a capital loss to offset capital gains realized elsewhere in your portfolio. By strategically realizing capital losses, you can reduce your overall capital gains tax liability. However, be mindful of the tax rules around wash sales, which prevent you from repurchasing the same or substantially identical investment within a short period of time. Tax-advantaged accounts. Contributing to tax-advantaged accounts such as individual retirement accounts, IRAs, 401(k)(s), or similar retirement plans can provide tax benefits. Capital gains realized within these accounts are generally not subject to immediate taxation, allowing for potential tax deferral or even tax-free growth, depending on the type of account. Capital gains exemptions. Some jurisdictions offer exemptions or preferential tax treatment for certain types of investments or capital gains. For instance, in the United States, there are provisions like the primary residence exemption, which allows you to exclude a portion of the capital gains from the sale of a primary residence from taxation up to certain limits. Familiarize yourself with the specific exemptions and preferential treatment available in your jurisdiction to optimize your tax planning. Gift or inheritance. Transferring assets as gifts or inheriting them can have tax implications. In some jurisdictions, the cost basis of gifted or inherited assets is stepped up to the fair market value at the time of the transfer. This step-up in basis can potentially reduce the capital gains tax liability when the asset is eventually sold. Consult with tax professionals or legal advisors to understand the tax implications of gifts or inheritance in your jurisdiction. Charitable contributions. Donating appreciated assets to qualified charitable organizations can offer tax benefits. In many jurisdictions, you may be able to claim a tax deduction for the fair market value of the donated asset while avoiding capital gains tax on the appreciation. It's important to note that tax planning strategies should be implemented in alignment with your overall financial goals and in compliance with the tax laws and regulations in your jurisdiction. Tax laws can be complex and subject to change, so it's advisable to consult with a qualified tax professional or financial advisor who can provide personalized guidance based on your specific circumstances. Additionally, while tax planning is a valid approach, it's generally not recommended to let potential tax savings drive investment decisions. Investment decisions should primarily be based on your financial objectives, risk tolerance, and investment goals.